Are you looking to learn more about investing in the central Indiana real estate market? You've come to the right place. Welcome to the Indy Real Estate Investing Podcast with T&H Realty, where we discuss all things related to investing in the central Indiana real estate market. Thank you for listening and enjoy the show.
Hello, everyone, and welcome to another episode of the Indy Real Estate Investing Podcast. I'm your host, Jeremy Tallman with T&H Realty. We are a residential property management company that services the central Indiana market. Today's guest is Jared Shore. Jared serves as the sales manager and mortgage loan originator for Hometown Lenders here in Noblesville. Noblesville, for those of you who don't know, is just a bit north of Indianapolis, certainly within striking range of doing deals here in Indianapolis. So sure. Welcome to the show, Jared.
Thank you. Thanks for having me. Appreciate it.
Sure. So I ask you on here, Jared, because let's face it, things are a little weird right now in the real estate industry, mostly I think because of the cost to get a loan has risen dramatically over the last few months. And I think a lot of investors are kind of frozen right now. They're not really sure what to do in this market. So I had you on here. Hope you can shed some light.
You picked a really great time to bring a loan officer on. Thank you.
I did. And it's very intentional because I think, I'm hoping you can shed some light and help give investors a better sense of kind of where things stand now, where things may be headed. And then bottom line, like what products are out there for people interested in from the investor perspective for investing here in central Indiana. So before we dive too deep into that, why don't you give people a little background, where you grew up, what schools you attended, kind of your LinkedIn profile, so to speak.
Fair enough. I grew up here in Noblesville. I'm a Noblesville guy. I've been here for 30 plus years. Graduated high school from here. I went to school at Auburn University. So I actually went down there. I played baseball down there and studied a little bit of everything. Landscape horticulture was my major down there, and ended up in finance doing mortgages. So I've been doing mortgages for the last almost 10 years. So I got into 2013 was kind of when I joined the real estate world via mortgages, and so seen some ups and downs. Obviously post 2008, so never got to see that, but definitely seen our fair share of ups and downs, and really started in the refinance game. Is where we kind of started out at, and moved into purchase business focusing, and then we kind of fell into this niche of real estate investors, which we love. So it takes a lot to know how to do a loan in general as a mortgage loan officer, and then to be able to tie it into how investors operate is a whole nother level of understanding mortgages. So it's kind of a niche we fell in love with, and we kind of are thriving in that.
Yeah. Well, thanks for that. I got to circle back for a minute. You played baseball for Auburn. That's a good baseball school, right? I mean, I don't know college baseball per se, but it's a Southern school, big conference, big school.
Yeah, for sure.
What position did you play?
So I was a pitcher. I pitched.
Wow.
Yeah.
And what was your go-to, like fastball?
Now, I didn't. If you look at baseball now, those guys throw so hard. Everybody throws 95 plus. I was not that guy. I was a finesse guy, threw upper 80s, could hit 90 if I needed to, but I had a good changeup. I had a really good change. That was my go-to.
Wow. Well, that's really interesting. So So you mentioned you found this niche, Jared, with investors and stuff. So just a baseline, you don't have to give me an exact, but what percentage of your business do you do with investors?
Oh, right now, probably 75% of our business is investors, if not more than that. So
okay. So the market, obviously, as we alluded to earlier, is changing. Give someone a sense out there right now. If I'm someone that's interested in investing in central Indiana, and I say, hey, I'm not paying cash, so I need a mortgage. I come to you. What are you telling me today?
Sure. Well, I think the biggest thing for us, what we're trying to figure out is what is your goal, right? What's the ultimate goal for the investor? Because there's so many products out there. And so really kind of honing in on what the long-term goal is with this property. Is it a Are you trying to flip it? Or are you trying to hold this long term? So we kind of, what we try to do is we try to be a one-stop shop for everybody, right? We have your hard money loans where we can do your fix and flips. Yeah. And then on the return side of that, be able to refinance those if it's a BRRRR strategy. We have loans where you can buy turnkey, so it really kind of depends on what the strategy is there. And the thing is, in the last couple of years, everybody's gotten spoiled with these low rates, right? And so it was easy. It was, we saw a huge switch in 2020, when COVID hit, where everybody was doing conventional loans, even on investor deals, right? Because why not? The rates were crazy low. And so now that the rates have obviously drastically gone up, we've seen almost a huge switch in our business go from conventional deals to more DSCR, LLC style loans. And so that's
break that down for someone who may not know what that means.
Yeah. So a DSCR loan versus a conventional loan. Conventional loan is just your standard everyday run of the mill mortgage, right? We're looking at we're looking at your personal income. We're taking all of your debts that you pay, including your what you pay on your mortgage, into account. And you basically have to qualify with your personal income and debt to income ratios. And you also can only close those deals in your personal name. So you don't have the ability to close those in an LLC. A DSCR loan is more of a business purpose loan. So you can close these in your LLCs, and we don't look at your personal income. It is strictly based off of the cash flow of the property. So this is a very, rule of thumb. If your mortgage or if your rent that you're going to be receiving on that is more than what your mortgage payment is, that's cash flowing in our mind. So you would be able to qualify based off of that.
Okay. So do you even look at their personal, do you run credit on them or anything?
We do run credit. They would sign as a guarantor on the loan, but gotcha. we don't look at any of their income. The only thing we're really looking on their credit per se is, do they have any bankruptcies? Are they habitually late on their mortgage payment? Things like that. Right. But we're not taking any of their debts per se into account.
Okay. So if I come to you and I want to go conventional, tell me what my credit score would need to be today, and then tell me what kind of interest rate based on 20-year, sure. 30-year AM, or whatever you're offering.
Yeah. So conventional loan, rule of thumb, 640 and higher credit score will get you into the ball game. You're gonna anything below 700, you're gonna have a hard time getting a really, really great rate on that. So obviously the higher credit score, the better deal you're going to be getting on that. But 640 will get you in the playing field. And there's no limitations, on loan to values or anything like that based on credit score on a conventional loan. Credit score, this is where it gets interesting in this market. But you're definitely looking at probably 7.5 plus on
interest rate. You're saying
interest rate, yeah, right. On any kind of interest rate. And honestly, regardless of credit score right now, that's probably going to come with some sort of points involved, just to get, on the rate sheet, if you will. Everything costs more right now. And there's no such thing as, a par rate. And a par rate in the mortgage world is where it doesn't cost you anything from a points perspective to get that rate. It's what you qualify for. So there's the par rate. And then if you want to buy it down, if you've ever heard of that phrase, you can buy your mortgage interest rate down by paying a little bit of interest up front. And in return, the lender is going to give you a lower interest rate. So it usually makes sense long term. However, in this market, there's no such thing as a par rate. Everything's coming with some sort of points.
Well, so you said 7 and what was that again?
Right, 7.5 plus.
7.5
we've been seeing a lot of 7.625. And just to put that into comparison, the average right now, as of this week, what is today? October 21st, whatever today is. The average primary resident, non-investor loan conventional is 7%. So a 7% interest rate on a primary loan. So 7.625, 7.5, wherever that ends up, it isn't that bad comparatively.
Right. Yeah. I mean, it's not that right. You're right.
It feels awful because where we've seen rates in the past. But,
Yeah. So January 1 of this year, I mean, I know you can't go back in history and remember all that, but
probably
what
we were in the fours.
in the
We were in the
fours?
fours. Yeah,
Okay.
rates have gone up almost 300 bips or 3% this year.
Okay. All right. That puts it in context. So,
Yeah.
you brought up a point about putting it in your personal name. And, when we started building, Scott and I, my business partner and I started building our business, we put everything in our names because
Mhm.
we got we got favorable terms that way. But I remember like the mortgage laws are changing so quickly and back then, and this was 2000, 2005, or between 2000 and 2005. How many mortgages can I have in my personal name today?
Yeah, typically 10.
About 10.
10 in
Okay.
your personal name. There are some I've seen some out there, some lenders that are allowing up to 15 now. And my guess is maybe somewhere down the road, Fannie and Freddie will allow for more.
Right.
Uh, who knows? But for right now, 10 is the max.
Okay. Yeah, it used to be all over the place. It was 3, it was 5, it was 7, it was
Yeah.
10, then it was 3. I mean, I just remember it going back and forth rapidly
Yeah.
within a few months. And then that was like you mentioned, Freddie and Fannie. If you went portfolio with a lender, then that changed
Yeah.
things, but they typically would want a commercial loan at that
Yep.
point. But so, okay, well, that sets the stage for or sets the table, I guess, for the conventional loans. If I want to buy a property in my LLC, based on cash flow, what kind of terms am I looking at there?
Yeah. These get a little interesting because these don't follow any, Fannie Freddie rules. Most of ours, almost 90% of ours are 30-year fixed rates. And this in this market, it's very interesting, right? We just talked about par rates and what a par rate is. You'll actually see par rates on DSCR loans, where you may end up with the same rate or a slightly higher rate than what you would on a conventional loan, without the cost of getting that rate. So if you compare these side by side just on rates and fees, you're like, well, look, man, that DSCR loan looks pretty attractive right now compared to a conventional loan. There's a catch, because conventional loans do not have prepayment penalties, right? Whereas DSCR loans do have prepayment penalties. So the whole strategy right now, a lot of people, they're like, well, hey, let's go ahead and knock these deals out, even though they're higher rates, assuming that rates potentially will go down over the next year or a couple of years, and we'll just refinance out of it. And that's a great strategy. You do have to take into consideration, though, that if you are doing a DSCR loan with the strategy of refinancing, you may get hit with a prepayment penalty. So the way I look at it is DSCR loans are hitting you on the back end with these prepayment penalties, whereas conventional loans know you're going to refinance too sometime in the next couple of years, and lenders are kind of getting their share of it up front. So so you kind of have to look at that and take that into consideration. If it is a long-term hold, you're not going to touch it for 3 to 5 years. The prepayment penalty probably doesn't even come into play for you. But if you are planning on refinancing a DSCR loan in the next year to two, you just have to make sure you're very aware of what those prepayment penalties are.
Right.
But most of them are 30-year fixed. We know cash flow is hard right now with higher interest rates. So there's some new style loans. You hear of ARM loans, right? Adjustable rate mortgages. Those are they're still not pricing out favorably right now. But there are some weird loans, like a 40-year interest only loan.
Right.
For investors. And we've seen a lot of interest in these right now. It's a 10-year interest only loan. It's a fixed rate. And then after 10 years, it turns into a 30-year, just amortized loan over 30 years. The assumption there is you're not going to keep that loan for 40 years. You're going to refinance it at some point in those 10 years. But during that time, you're going to be able to cash flow and, make some money off of that.
Wow. When I talked to you last week, you brought that up. I had never heard of it. I mean, that's just something that was so foreign to me. When did that start? A 40-year amortization.
They started coming out with them probably in the last year, but the rates were so good over the last year. I guess I should say late last year, early this year, that and even into the summer of this year, the 40-year interest only just didn't make a whole lot of sense. But now that rates are, they're just so high compared to what we've seen, that like we ran one where, and you are going to take a slightly higher, and usually a quarter point higher on those than what you would on a 30-year fixed. But with the amortization the way it is, even with a quarter point higher, the one we ran the other way, it's almost a $200 difference. And obviously the loan amount's going to dictate some of that. But the one we ran was about a $200 difference in payment per month.
So yeah,
just the way it amortized.
Okay, so it's not necessarily a great way to save or to gain cash flow necessarily, because your rates are typically going to wash all that out in some ways.
Yeah. Well, no, and the whole point, I guess, is to gain cash flow per month. Now you're not going to gain, I guess, equity per se, because you're not paying that loan down. Now you will, obviously, assuming that the housing market still appreciates a little bit, even though it may slow down from what we've seen. But yeah, you'll save some money per month on your mortgage, which then in turn, gains you a little bit extra in cash flow per month.
Okay. I guess I misunderstood what you said. So you're saying that the 40-year mortgage, the interest rate is higher.
It's a slightly higher rate, but because the way it amortizes out, your monthly payment's going to be lower. Correct.
Okay. Sorry about that. Yeah, I got you now. I think I misunderstood you before. So, okay. That makes sense to me now. So, but yeah, thanks for sharing that. That's just, I'm going to guess there's some people out there that have never heard of that. It is an interesting product, but you're right. If you're looking to gain equity and do that pay down, it's going to be a slower road. That's for sure.
And to be fair, it's not a great loan. I mean, I would never advise somebody like in a normal market, hey, you should do a 40-year interest only loan, right?
Right.
That is not, and I guess it depends again on what your strategy is. It's a great deal if you're trying to cash flow a little bit more. It's not the greatest deal if you're trying to pay your loan off anytime soon. So, again, I think it's just making sure you know what your business model is and does that loan fit into it at that point.
Right. Okay. Well, great. So if I'm listening to this podcast, you mentioned it's October 21st, 2022, and I'm listening to this podcast in, let's say, January of 2023, and you quoted 7.5% today. Is that a good rate in January 2023, or what are your thoughts?
Yeah, I mean, man, people that are predicting rates right now, I don't envy them at all. There's so many things you have to get right to kind of figure out where the market's going, right? I'm no expert in that by any means. I think from what I've read, I think it would probably be a pretty good rate right now if we're comparing it to January. I do think we'll probably see rates either stay where they're at or maybe trickle up even a little bit higher than where we're at right now. And then, maybe end of quarter one, going into quarter two next year, I hope we start to see rates go back down. And I don't think we'll ever see them in the 4s and like that for investment deals again. But I think 5s and 6s would be a really good goal for us. That's where I'd like to see rates get back to, is doing mid 5s and 6s for investment properties.
Okay.
So when that happens, I don't know. I mean, we've got this lingering recession. We've got the feds, raising rates. We've got war going on. Just there's so much uncertainty, I guess, right now.
Yeah. Do you think we'll hit 10%?
I can tell you, I've seen 10% rates for DSCR loans with lower credit scores. Gotcha. I've seen some 10% on the rate sheet. Those are still kind of in the high 7s, low 8s for most people, but I have seen 10 start to hit the board.
Wow. Okay. So talk about your business a little bit here. And, back before this year, you were probably doing tons of loans and there was a lot of homes being bought by investors, and we're seeing it here. I was talking to our brokerage yesterday, and I said, I signed 3 price reductions, like amendment to purchase agreements, this last over the weekend, and then last couple of days here. And I don't remember signing one. I was like, it feels like a year ago. It's been so long since we've had to reduce it. So prices are coming down. People are a little shy about buying homes, obviously, with interest rates the way they are. How has your business had to adjust? What are your conversations like with investors today on the buy side?
Yeah. Obviously rates a huge topic of conversation, right? Rates are just kind of are what they are, but they're important to look at. But what we've kind of, it's a cliche kind of quote, but it's marry the property and you can divorce the rate later, right?
Mm-hmm.
Because I think there's a lot of opportunity out there right now because some of the people are backing out of the market to buy. So the competition level has drastically reduced, which gives a lot of people an opportunity to go snag a deal,
Right.
especially under value. You're not having to pay $20, $30 plus $1,000 over asking just to get your foot in the door. So yeah, we've seen a lot of I don't want to say undervalued, but under list offers and getting them accepted, even with seller concessions too. On top of that, I haven't seen seller concessions in the last couple of years at all, and we've seen several in the last few weeks. So, it gives an opportunity to go in and snag a property, and even with the higher rates, I think being able to get that property at a lower price point than what you would have with a lower rate at a higher price point, your cash flow is going to be roughly the same, in this market. So yeah, get as many properties as you can is what I kind of talk to people. If you have the opportunity, make sure obviously you're not losing everything on it, but if you can get a property that still cash flows in this market, just think about how much it's going to cash flow when the rates go down and you're able to refinance. And even when you refinance, lower that payment, your property value is still going up. So even if you're on one of those, wonky 40-year interest only where your mortgage payment's just staying here, that property value is still going to go up. You're still building equity in that property. So, it should still be you're going to win one way or the other.
Right. Yeah, it is. It's a good point. I think, we're seeing prices come down. It's going to allow people to maybe pay a higher rate and still come out from a cash flow, maybe net neutral when it's all said and done. But
I think there's some interesting things in the market with rent too, because, what's happening is these people that now may not be able to afford a primary residence home, they got to live somewhere.
That's right.
So, rent is probably going to be more attractive to a lot of people right now than buying, even though, us as mortgage lenders, we'd love to tell everybody that buying is a better option than renting. But then, and a lot of times it's not. So, it kind of depends on the person. So there's a lot of opportunity for rent out there.
Yeah. I mean, I think, rents I just reviewing some numbers. We have a blog coming. We do a quarterly blog about rental statistics. Just kind of summarize Central Indiana, and, rents broke yet another record in Q3 of 2022 here in Indianapolis. This is stuff through the MLS system, right? It's our BLC. So, we can't get every Joe that puts a for rent sign in his yard. We can't get that data, but what we can do is just track trends through the BLC to give us some baselines of things. And yeah, we set another record for rents. I think they're up over $100 from this time last year per month.
Yeah.
So we'll see how that plays out. We've seen some slowing in the rental market.
Sure.
It always happens in the fourth quarter. It's a natural thing we deal with. But what we're seeing, because rents have went up so high, tenants are getting sticker shock. So instead of moving, they're just trying to negotiate a better rate to renew. And they're not probably buying because what they could afford when they signed that lease a year ago, they can't afford today just because the rates are different. So
what are your thoughts going into next year on, especially here in the local market, the Airbnb market? What do you think that's still going to be a hot hot topic, or do you
You
think that's
know,
going to slow down?
I am not the guy to talk about the short-term rentals. We don't do it. We have some
Yeah,
clients that do it. Talked to a guy who used to work for us last week. He's kind of into it now. I just, to me, if I'll say this, if I'm a landlord, and I self-manage, which most landlords self-manage. I think it's still over 60% of landlords in America self-manage. Airbnb would be a difficult thing for me to do because it's so constant. But if you got a good manager, that makes it easier, right?
yeah,
So you put that
yeah,
burden on them. But to answer your question more directly, I don't have a sense of it because we're not involved with it. We've talked about it as a company. Do we want to get into it? Haven't had a lot of like, I won't say the word pressure, but a lot of like push from some of our clients to do it. Some of us ask, some of our clients have
sure.
asked us about it. Just had a client we picked up just very recently. This actually last week we picked them up and have a nice portfolio. When one of them was a potential for an Airbnb and they decided against it. They just said they like the stability of a long-term renter in there. But
Yeah.
that's just one person, one opinion. What are you seeing? I mean, what are your thoughts?
If you would have asked me a couple of years ago if I thought the Indy market, especially, and even the north side, like Hamilton County,
Mm-hmm.
was a great Airbnb market, I would tell you you're crazy. But it blows my mind how many clients we have that we do Airbnb lending
Really?
for. So yeah, it's a kind of a niche product we do. But I don't know. It's interesting because that was something we didn't have the ability to do, and now we do, and it's kind of taken off from a lending standpoint.
Right. So you have a specialized product, I'm sure, with insurances, or I'm sure insurances are
Yeah,
required differently and things like that.
no, it's more so the way it's 100% a DSCR loan.
Okay.
I guess you could do it as a conventional loan because as long as we don't really care about the rents or anything at that point. As long as your income qualifies. But from a DSCR standpoint, if you don't have a history of Airbnb rent on that property, we would just use the long-term rent on the property from an appraisal standpoint. They'll give us the market rent. And as long as your market rent covers your mortgage, then you can use it as an Airbnb.
Okay. Because you assume, obviously, in a
If
short-term rental
Yeah,
that you're going to beat a normal market
you
rent.
would
That's the
hope
only reason you
so.
do it.
You would hope so.
Right.
And I guess the other assumption is if it turns out to be a bad Airbnb, you're going to turn it into a long-term rental and put somebody in
Right.
there with a rent. So
Yeah. Yeah. You
um,
move out your furniture and
yeah,
you just go. Yeah. Yeah. I mean, I guess it's easy to convert. It's probably easier to convert into a long-term rental than the opposite because
correct.
you have a lot more things to consider
Yep.
when you convert it to a short-term rental. So, okay. So I'm going to flip it over here. You kind of talked about the advice that you're giving real estate investors today on the buy side that, I liked what you said about, you know, you marry the property, but you can divorce the rate or, something like that. I like that. Um, do you talk to many sellers? I mean, do you have just clients that are like, hey, I did this loan with you 4 or 5 years ago and I really need to sell it, but I'm not sure this is the right time to sell it. I can tell you this, our clients have backed off selling like a lot.
Yeah.
And I don't know if it's because the stock market has not been great either. And they're like, what am I going to do with this money? And they're still all sitting on a ton of equity if they bought
Yeah.
3 or 4 years, 5 years ago. But do you talk to sellers much at all and offer advice that way?
So we don't talk to a ton of sellers. If we talk to a seller, they're usually coming to us to get pre-approved to buy like their next house, right?
Mm-hmm.
And then we have this current property that they have on hand that we have to kind of deal with, and we've had a lot of people back out from there because they're the hard part for them is, why would I sell a property right now where I've got maybe a 3 or 4% interest rate on, and I'm going to go buy another property that's now overinflated from the last time we
Right.
bought at a 7+% interest
Right.
rate, and increase, so their buying power has drastically reduced. So it's a hard conversation. There's usually the people that we talk to that are sellers is a really specific reason they're moving, whether they're transferring jobs or something like that. We don't see a whole lot of people that are just moving to move
Right.
right now.
Right.
So,
Okay.
but to answer your question, no, we don't talk to a ton of sellers.
Gotcha. So appraisals, let's talk about appraisals for a little bit. Back when the market was flaming hot, you were talking about seller concessions now, where there are all these buyer concessions
Yeah.
back in the day with, appraisal gap coverage and just we'll buy it under any circumstances,
Yeah.
basically.
Yeah.
Now that things have cooled a bit, are you still seeing appraisal issues, whether it be on a new purchase or even refis?
More so in refis. Refis are a lot. I do not envy appraisers at all, that have to go out and do these appraisals right now. Purchases are a lot easier because, we're giving them the purchase agreement. They know what the purchase price is. They've got a target to shoot for, and so they know what the number is. And usually if that number is going to come in low, there's a conversation around that, or at least they know that it's going to come in low. Whereas a refinance, we're just saying, hey, go appraise this property. Right. And they don't know anything about the deal. They don't know, they're just going out and giving us their honest opinion about it. And so I guess where we see quote unquote low appraisals isn't really necessarily, I don't really, some appraisals that we get are just, in fact, we had one last week that came in 30 or 40 grand low. We disputed it and it came back where we needed it to. So there is a dispute process that you can go through, but usually a low appraisal and a refinance, assuming it's a good appraisal, means one of two things, in my opinion: that the borrower, in our case, usually the investor, had a really inflated number in his or her mind about what that property should appraise for. They're looking at comps that aren't really comps. It's the house down the road that sold for X number of dollars, and now they think that their house should also sell for that, even though it may be completely different style property. So it's usually the investor not 100% understanding what their property should appraise for, which is why I always tell people, you got to have a good team around you. You got to have a good real estate agent. Even on a refinance, you need a good real estate agent that can give you that good advice. Don't take a wholesaler's word for what your ARV is going to be on a property. I see so many people get into trouble. Well, this, so-and-so wholesaler told me that if I put this much work into a property, it's going to appraise for X number of dollars. But we have seen a slowdown in appraised values, if you will. So I don't know. It's a complicated question because there's just so much that goes into an appraisal. I can tell you that most appraisals, wherever it comes back, is right, for whatever. And that's the hard part with appraisal. You can have 2 or 3 appraisals done with 2 or 3 different values and justify probably all 3 values that are given.
Yeah. Yeah. It's not necessarily a science. There's some art to it. And, I've been on the bad end of an appraisal on homes that we've sold. And it's like, well, but what about this? So it's, you go back and forth, and we've won some. And just like you mentioned, there's a dispute process you can go through, but, a lot of times those don't work out either. They kind of hold firm to where they are. So
I always tell people, the 2 pieces of advice I give, especially on refinances, purchases too, but give the appraiser a list of everything you've done to that property. Especially with the rehab. That way they're comparing your property to better properties if you've updated it. And it depends on which appraiser you talk to, but if you have a list of comparables that you think are good comparables, give that to the appraiser up front too, because that now you're giving, instead of doing it on the back end as a dispute, you're getting on the same page with the appraiser at the beginning. And they may use those comps, they may not, but at least get you on the same page. And if they can't use them, they're going to tell you why they didn't take those into consideration.
Okay. So just are you, when you're still doing refi, I mean, are those based off the refis where you said you were earlier in the show, you said something about you offer loans for rehab, and then you can BRR and move it into a. So are those, because I can't imagine many people are just doing refis.
The refi industry has gone down.
Right.
We haven't seen somebody call in and be like, "Hey, we'd like to lower our interest rate," and do just a regular refinance. Right. That's not a thing anymore.
Yeah.
And if they are lowering their interest rate in this market, it means they haven't refied since probably mid 80s, mid 90s. So
got one of those 40-year mortgages.
They missed the boat.
Yeah.
No. So I mean, every once in a while we'll get the refinance to take some cash out of their property, do a home improvement project or something like that, pay off some debt. But most of our refinances we're doing right now are BRRRR strategy. We did a rehab and now we need to get out of it.
Right. Okay.
Or get out of kind of a hard money, high interest rate loan.
Yeah. So bottom lining it, I mean, I know you're a mortgage guy, so you obviously have interest in doing more loans, but your honest opinion about the market, I mean, you're telling people, hey, buy it. You can always get a better loan down the road. But how is that message resonating? How are you, I'm assuming you're seeing a drop in business. Everybody probably has, but are you still seeing a steady stream of people that are like, hey, look, I'm going to buy. I found a good deal. This is a long-term thing for me, and I want to buy this property.
Yep. I mean, we've seen our share of business pass on deals too that they may have been under contract too, because the rates are different and their numbers that they originally looked at are different. But here's I guess a bigger analysis on why I think it's important to buy now instead of wait, because there's going to be this kind of ebbs and flow of price values and rates. Because the minute these rates go back down, guess what's going to happen? There's going to be an influx of buyers that come back, and now we're in a competitive market again, which is going to drive house values back up. Okay. And so most investors that we deal with are numbers people. Right? At least they think they're numbers people, but most people are a numbers person. So if you do the math on this, if you buy now at a lower price point with a higher interest rate, as opposed to waiting down the road, now all of a sudden the price points may be a little higher, your interest rate may be lower, your payment is going to be essentially the same, right? Except there's one difference in that scenario is your out of pocket that you're going to pay, because now you're putting a down payment on a higher priced home, which now you have more money out of your pocket. So it makes your return on investment less by waiting for that lower interest rate.
Right. Yeah. You said you got into this, you said 2013. Is that right?
Yeah.
Okay. So we started buying in 2000, and 2007 hit. 2007 is when it really started hitting hard. And in 2008 through 2010. And it was the same thing. Everyone was paralyzed, because it's like the market was going down, foreclosures were going through the roof.
Yep.
And it's like, why would I want to buy into this weakness? Well, I wish I had. In hindsight's always 2020, but we bought our homes. Most of our rentals were bought between 2000 and 2005. Now, we were doing a ton of flipping in those days because share sales were huge.
Yeah.
The opportunities were great. And there were still buyers, as long as condition was really, really important back then, because no one had any money to buy a home that needed work. So people would buy homes that were freshly rehabbed, which we could offer. But we didn't add to our rental inventory back then. And that is a regret. And so, look, I'm 50 now. And I'm like, do I want to buy many more rental properties? Really? What's my time frame here? But we're talking about it. And it's kind of exciting, because I think there are opportunities out there to buy now.
Yep.
And I don't want to make the same mistake twice, because I think we missed a great buying opportunity back then.
Sure.
And I think we're starting to, I don't think it's here exactly yet. I don't think there's like all these tremendous deals yet, because sellers are going to have to adjust. Sellers are going to have to be more reasonable. And you're seeing that through price reductions and things like that. We've got some examples of homes we bought for investors like 12 months ago that they're now selling for a lot less. But I think generally speaking, we're going to have to, sellers are going to have to loosen up a little bit before those really good deals come out.
We've seen a lot of first-time home buyers be able to get homes in this market that they weren't able to get, in the last several months. So, and it's because sellers are allowing them to buy these homes. There's not as much competition. So, yeah, I think it's a great time. I think it's a great time to buy. It's not the best time. Again, if your analytics are just looking at interest rates, it's a terrible time to buy, right? But there's more to it than interest rates for sure.
Yeah, great. Well, Jared, hey, this has been great. I thank you for joining me. If someone wants to connect with you, what's the best way to do that?
Yeah, 2 ways. You can always call my cell, 317-931-9759. Get a hold of me via email. It's jared.shore@htlenders.com. And follow me on social media, all that fun stuff. So,
it's Jared. I think Jared spelled it out in 9 different ways, but Jared.
Mine's the right way.
That's right. All right. So I did have one other thing for you, but tell me, I just got some quick questions for you. For people that aren't like part of or don't live here, which most of our listeners probably do not live in Central Indiana. What's your favorite restaurant here in Central Indiana?
Oh man, that's a tough one. My favorite restaurant, I love Kobayashi. Kobayashi is a little, or Thai Kitchen in Fishers at 116th and Allisonville is really, really good. I love Thai food. So
we had Thai last Friday, and there's a new, relatively new spot that opened up on Mass Ave that we're probably going to try this weekend. It's good.
In Indy, I love Bakersfield down on Mass Ave. Bakersfield's great if you like some tacos.
Yeah. Favorite bar if you imbibe there? What's your favorite bar here?
So in Noblesville, I love Sid's. Sid's is an old school bar right on the square in Noblesville. It's been Sid's, SYDS.
Okay.
It is nothing to write home about, but it is an awesome place. It's
an
old school place.
All right. So do you live in Noblesville?
Yeah.
Okay. So if you could live anywhere in Central Indiana and price was not a factor, where would you live?
Central Indiana. I'd probably say Noblesville. I love Noblesville. Yeah, it's Hamilton County. It's you're kind of right here. You can get to anywhere quick. There's a lot of good restaurants around here.
Okay, fair enough. Well, we hope everyone's picked up some information that'll help them in their investing, and we'll be back next month with another podcast. Jared, thanks so much again.
Thanks, Jeremy.
You've done, and in the meantime, we encourage you to share this podcast with your investing friends, leave us a review, and don't hesitate to reach out to us if you have any questions at all. Until next time, thanks so much for listening, and please stay invested in your investment.